What if I told you that in an extreme but plausible scenario over the next 2 years, we could see the S&P 500 surge to an all-time high of 8,500, creating a wealth myth unlike anything we've seen before. But at the very same time, this could also be the opening act of a crisis, a longer, deeper, and more painful economic winter than 2022 quietly approaching. What would you do? Go all in and enjoy the final surge of madness, or exit the market entirely and retreat to a safe haven? This isn't alarmism, and it's not a doomsday prophecy. It's the most likely script derived from today's tangled macroeconomic data, labor market conditions, and historical economic cycles. Today, we're going to cut through the noise of the headlines. By closely examining recent employment data, inflation trends, and the Federal Reserve's policy dilemma, we'll reveal a path shaped by both potential prosperity and enormous risk. What we're discussing today isn't just about numbers. It's about the survival rules every investor must understand on the eve of a major turning point. Let's start with the most exciting part of the market, that seemingly unreachable 8,500 level. Many people feel the market is already extremely high. The S&P 500 has surged from its 2022 low of around 3,500 to roughly 6,800 today, an increase of nearly 90%. By conventional logic, that looks like a massive pull forward of future gains. But in the eyes of Wall Street's most bullish voices, like Tom Lee, this party isn't over. In fact, it may only be entering its most intense phase. So why is the market daring to make such aggressive predictions? The core logic is this. Over the next 2 years, markets could enter a euphoric phase driven by two powerful engines: AI-driven capital expenditure and interest rate cuts. The first engine is AI infrastructure. This isn't just hype around a few concept stocks. It's a capital spending wave on the scale of an industrial revolution. Tech giants, desperate to secure their place in the future, are spending aggressively and without restraint on hardware computing power and energy infrastructure. This sustained investment will translate directly into revenues and profits across the supply chain, providing real earning support for valuations that currently appear expensive. The second engine is Federal Reserve policy. While rate cuts may seem hesitant right now, the overall direction is clear. Lower interest rates mean lower borrowing costs. And when money becomes cheaper, it doesn't just flow into the real economy, it floods into financial assets. With these two forces working together, we could very well see explosive growth in corporate earnings and financial performance. That creates a powerful illusion that high valuations are justified, that they're the new normal. And there's one more crucial detail that deserves attention: the explosive potential of small-cap stocks. From last December until now, what we've been seeing is a split market. The S&P 500 is up about 13%, while the Russell Index, which represents small-cap stocks, is up only 6%. The reason is simple. Smaller companies rely much more heavily on debt financing, and high interest rates have been suffocating them. But once the rate cut cycle truly begins, that financial pressure will be released almost instantly. We expect rate cuts to help small caps close the gap with large caps, and potentially trigger an even more aggressive catch-up rally. That's why this rally is unlikely to be a solo performance by a handful of tech giants. Instead, it could turn into a full-scale market celebration, spreading from mega caps all the way down to small stocks. With retail investors piling in and sentiment running extremely hot, an additional 25% to 30% gain in the S&P 500 over the next 2 years, pushing it toward 8,500, is not a fantasy. But friends, this is where I need to pour a bit of cold water on the excitement. Financial markets follow an unchanging law of nature. Just like the 4 seasons, markets cycle through 4 stages: hope, optimism, belief, and finally, euphoria. So where are we right now? We've just completed the transition from optimism to belief. In this phase, investors start to believe the bull market is real, and every pullback feels like a buying opportunity. Then comes 2026, the most seductive, but also the most dangerous phase, euphoria. In that stage, making money feels incredibly easy. Huge short-term gains cause even rational investors to doubt themselves, while cautious people start to look foolish. Market sentiment shifts from greed to extreme greed. People begin to believe that stocks only go up, but history tells us that euphoria is often the end of the cycle. These risks are not guaranteed events, they are growing threats. You might ask, if the market looks so strong, why should we worry about a crash? Where is the hidden danger actually buried? The answer isn't in the stock market. It's in the foundation of the real economy, the labor market. While stocks are rising, the latest jobs reports are sending out piercing warning signals. What we're seeing is a labor market that is steadily weakening. Some would say deteriorating. This isn't just about a few boring percentages. It reflects the livelihoods of millions of families. First, the unemployment rate has climbed to 4.6%, a very clear upward trend. Even more concerning, from January to November 2025, companies announced nearly 1.2 million layoffs, a 54% surge compared to the same period last year. These layoffs are hitting across a wide range of industries. Telecommunications ranks first, followed closely by technology, then food and services. This tells us that layoffs have spread from high-tech firms into basic service industries, a very dangerous signal. What's especially worth highlighting is that the job displacement effect of artificial intelligence has already begun to surface. In November alone, more than 6,000 jobs were cut due to AI, and the cumulative total for the year has exceeded 50,000. This is no longer a sci-fi prediction, it's a reality that's already unfolding. Beyond unemployment, there's an even more deceptive trap, the claim that wages are now outpacing inflation. Current wage growth is running at 3.5%, while the officially reported CPI inflation rate has fallen to 3%. So mainstream media starts celebrating, claiming real incomes are rising and purchasing power is recovering. But I need to be very direct with you. This view is completely wrong, because it confuses two very different concepts. The CPI report measures only changes in the cost of living, and statistical agencies can smooth the data through substitution effects. That does not equal true price inflation. If you feel like groceries are still getting more expensive while the data says inflation is falling, trust your wallet. Don't believe the polished headline numbers. And even more alarming than CPI is what's happening beneath the surface. The money supply, which is flashing bright red warning lights. According to the latest data from the Federal Reserve's own website, M2 money supply has quietly hit a new all-time high, with recent annualized growth reaching 5%. And it's not stopping there. Just last Friday, in response to economic slowdown, the Fed officially restarted the money printer and began cutting rates. That means the credit floodgates are open again, and more money will surge into the economy through the lending system. We expect money supply growth to soon approach 6%. Basic economics tells us that a surge in money supply is always a leading indicator of inflation. Today's rate cuts are like pouring gasoline onto a fire that was just starting to die down. So don't be fooled by the current 3% CPI reading. In our projected scenario, driven by this monetary flood, 2026 will bring a sharp acceleration in inflation, creating an extremely difficult macroeconomic environment. On one hand, inflation resurges in 2026, pushing corporate costs sharply higher. On the other hand, the rising unemployment we discussed earlier continues to weaken consumer spending power. Even Federal Reserve Chair Jerome Powell himself has admitted that official employment data may be significantly overstated, potentially by as much as 60,000 jobs per month. And if even the official numbers are painting an overly optimistic picture, then the true condition of the underlying economy may be far worse than what we're being shown. Everyone knows this. For a central bank, the hardest situation to manage is not pure inflation, and not a simple recession, but the combination of both. Stagnation and inflation at the same time. And step by step, that is exactly the dead end we're being pushed toward. On one hand, to support the stock market and fuel AI development, the market needs massive amounts of capital. The Federal Reserve is pressured to cut rates. But cutting rates is like pouring fuel on the fire. It keeps pushing inflation higher. On the other hand, the labor market is steadily weakening through rising unemployment and declining real wage purchasing power. Economic growth momentum is fading. This traps the Fed in an impossible dilemma. If rate cuts come too slowly, as we're seeing now, they may fail to stop the labor market from collapsing, leading to a hard landing for the economy. Many believe the Fed is already behind the curve. But if rates are cut too aggressively, if the Fed starts printing money recklessly to save the market, then the inflation monster breaks out of its cage. We should never forget the lesson of the 1970s. Once inflation reignites, it often comes back more violent and more destructive than the first time. Current forecasts suggest that this combination of high inflation and high unemployment, stagflation, will become increasingly visible in 2026 as market dynamics fully play out. This is an extremely difficult macro environment. It puts double pressure on corporate profit margins and could ultimately puncture the stock market bubble. So, facing a future filled with both massive profit opportunities and enormous risk, how do we know when the market is approaching the cliff? Here, I want to summarize 5 warning signals of a late-cycle market. If you see these signs appearing together in 2026, you need to be on maximum alert. First, a surge in speculative capital flows. When money stops flowing into stable blue-chip stocks and instead floods into unprofitable, story-driven, high-risk assets, that's a major signal. Second, severely distorted return expectations. When people start feeling that a 30% annual return is boring or not enough, greed has completely swallowed reason. Third, record levels of debt and margin usage. When everyone is borrowing money to buy stocks and leverage explodes, the market becomes extremely fragile. Even a small shock can trigger a stampede. Fourth, extreme valuations. If the S&P 500's price-to-earnings ratio climbs to 35 times, 37 times, or even 40 times, those are historically rare bubble-level valuations. Fifth, and the most intuitive, euphoric market sentiment. Look at the Fear and Greed Index. If it stays in the extreme greed zone for an extended period, and the market ignores all negative news, that's the final frenzy. Now comes the most important question. How should we act in a market like this? My advice can be summed up in 6 words. Prepare, don't predict. Many investors obsess over calling the exact market top, trying to exit perfectly on the highest day. Friends, that's impossible. Market timing usually means getting hit on both sides. Facing the potential extreme volatility of 2026, our core strategy must be risk management. Your portfolio needs one key characteristic. It should participate in upside during booms and survive during crashes. That requires a disciplined execution system. To help you stay grounded in turbulent times, I've broken this approach down into 6 investment principles. These aren't just stock picking rules, they're armor for surviving the cycle. Step 1. Establish your core investment logic. Many people lose money because their thinking is internally conflicted. They buy with long-term logic, but hold with short-term get-rich expectations. Before 2026 arrives, you must define your rules. Where is your battlefield? Are you chasing high-growth tech stocks or stable dividend-paying blue chips? Where is your pain threshold? If a stock drops 30%, do you feel excited to add or terrified and ready to sell? If you don't know where you're going, every direction looks like the peak. Don't try to make all the money in the market. Only make money within your circle of understanding. Once your mindset collapses, everything goes to zero. Step 2. Reject complexity. If you don't understand it, don't touch it, especially in euphoric markets where concepts fly everywhere. Remember this, complexity is often the breeding ground of deception, while simplicity is the source of profit. If a company's business model feels like solving advanced calculus, or its financial statements read like ancient scripture, throw it straight into the trash. We only play games we understand. Step 3. Look for the ceiling. This determines your upside potential. In a macro environment that may slide into stagflation, we must find sectors that can grow even as the economy slows. Focus on total addressable market and penetration rates. The best companies operate in trillion-dollar markets with still low market share. That means even without crushing competitors, simply riding industry growth can double their size. We want ships sailing with the wind, not paddles fighting upstream. Step 4. An X-ray of financial health. Reject fake prosperity. Don't just look at revenue growth, that's surface level. Look at profits and cash flow, that's substance. In high inflation periods, be especially cautious of companies that rely on price hikes or aggressive acquisitions to sustain growth. Step 5. Identify an unbreakable moat. Pricing power is the ultimate inflation defense. Without a moat, high margins are just blood in the water, eventually eaten away by competitors. So how do we judge the strength of a moat? Look at pricing power. You must find a company's unfair advantage. If a company raises prices and customers complain but keep buying, it has a moat. If prices rise even slightly and customers immediately switch to competitors, there is no moat. Only companies with true pricing power can pass inflation costs downstream and protect your profits. Step 6. Position sizing and continuous review. This is the final step, and the one that ultimately determines how long you survive in the market. First, absolutely avoid using leverage. In the late stage of a cycle, leverage is a double-edged sword. It can magnify gains, but when volatility spikes, it can wipe you out instantly. Eliminate margin debt at all costs. Second, keep a portion of your portfolio in cash. Continue dollar-cost averaging, but optimize the structure. Don't stop investing out of fear, and don't go all in out of greed. Buying in tranches is the most effective way to smooth risk over time. Finally, buying is not the end, it's the beginning. Every quarter, when earnings are released, revisit your position using these 6 principles. The day the original investment thesis disappears is the day you sell. If, during your review, you find that the company's moat is narrowing or management starts lying, then regardless of whether you're up or down, you sell without hesitation. These 6 steps may sound complicated, but the logic is actually very simple. They do just one thing: bring you back to common sense. And of course, for most ordinary investors, if you don't know how to pick stocks, buying a broad market ETF is often the better choice. Standing at the end of 2025, we've walked through an extreme but plausible scenario for the next 2 years. The S&P 500 soaring to 8,500 could coexist with the dark shadow of high inflation and high unemployment, stagflation. It sounds contradictory, but this is the most brutal truth of the modern financial system. That truth is the growing disconnect between asset prices and the real economy. In the late stages of liquidity excess, stock market prosperity no longer reflects economic health. It reflects currency debasement and capital competing for safe havens. The next 2 years will be an extreme stress test of every investor's belief system. You may see friends get rich overnight by betting on speculative stocks. You may see disciplined value investors temporarily underperform the market. The noise will be louder than ever. The temptations will be stronger than ever. And that is precisely why we keep emphasizing these 6 investment principles. They are not designed to help you squeeze every last penny out of a bubble. They exist to ensure that when the tide goes out, when stagflation punctures inflated valuations, you are still holding core assets with pricing power and real cash flow. Remember this: financial history never repeats itself in a straight line, but human greed and fear always rhyme. Over the next 2 years, whether it turns into a capital feast or a painful purge, at its core, it will be a massive redistribution of wealth. Wealth never disappears out of thin air. It simply transfers from emotional, highly leveraged speculators to calm, objective investors who respect common sense. Don't try to predict the exact second the storm arrives. As investors, our job is simple: repair the roof before the storm, store enough supplies, and wait patiently for the cycle to turn. Thank you for watching. If you found this video helpful, don't forget to subscribe, like, share, and turn on the notification bell. And feel free to leave your thoughts in the comments. I'll see you in the next one.